as the price goes up in terms of a bond, the interest rate always goes down. Okay, now let me explain that a little bit, because it has to do with the basics of interest rates and the basics of bond valuation. And we'll go into much more detail about this later on in Lecture 1. But a Treasury bill is kind of a unique instrument in that it doesn't explicitly have a coupon. The Treasury bill promises to pay $100. In our example, it's going to be $100 in 1 year from now. Now, obviously, nobody buys that for $100. So if you purchase this 1-year Treasury bill at, let's say, $90 today, next year you know that you're going to get $100. The rate of return is $10, and a $10 rate of return on a $90 investment works out to about 11% interest. Okay, so the rate of return is about 11%. Now suppose that people start to purchase these 1-year Treasury bills because they expect a recession next year. Well, as soon as they do that, it's going to increase the price. So when you go from $90, let's say, to $91 or to $95, it's going to reduce the rate of return that people are going to get on the Treasury bill. So if we have to buy at $95, a year from now we get $100, and we get $5 in terms of the payoff. We invest at 95, we get 100. So the rate of return is 5 divided by 95. Okay, which is much smaller than 11%. So as people are trying to shift their money to hedge for what they expect to happen in the economy, we're going to see fluctuations in interest rates that are fundamentally linked to the state of the economy. Now that's one thing, and that's very important for determining interest rates. And there's clear, unambiguous patterns in interest rates and the business cycle. And this actually, I would refer you to, for example, my 1988 Journal of Financial Economics paper called The Real Term Structure and Consumption Growth, or my 1991 Journal of Fixed Income piece called The Term Structure and World Economic Growth. In both of these articles, I trace the relation between interest rates and the business cycle. And I do this for 7 different countries, the G7 countries. And I find that there's an unambiguous pattern in interest rates and what happens in the economy. And interest rates are forward-looking. That we're doing things today in terms of shifting our money. The people are buying the 1-year Treasury bill today. They're buying it today because of what they expect next year. So we can see things in interest rates today that help us distinguish what's going to happen in the future in terms of the economy. So interest rates contain expectations of economic growth. Now what else? The other obvious thing that interest rates contain are expectations of inflation. So if you expect that there's going to be 10% inflation over the next year, then there's no way that you're going to purchase a Treasury bill for $95. You purchase the Treasury bill for $95, you get a rate of return that's a little over 5%, 5.5%. But inflation is going to eat 10% of your investment. So the overall rate of return would be negative. They'd be throwing money away by investing in the Treasury bill. So if people expect a 10% inflation rate, then you can be sure that the Treasury bill rate is going to be lower, that the price of the Treasury bill will be less than $91. This will ensure that investors are compensated for inflation and make a little extra return. Now, sometimes people call this the real interest rate. So the interest rate that I quoted you, for example, with the Treasury bill of a price of 90 that has 1 year to maturity, that interest rate is 11.1%. And that's a so-called nominal interest rate. And when we say nominal, it means that it includes inflation within it. And often what we do is we consider real interest rates. So the real interest rate would be the rate after you subtract out inflation. So over the year, if 10% inflation is realized, I made an 11.1% return, a nominal return on the Treasury bill, but inflation was 10%. So the real return that I actually made was only about 1.1%. So the real interest rate in this case that was realized over the investment horizon was about 1.1%. So often people talk of real interest rates, people talk about nominal interest rates. So these are two fundamental building blocks of interest rates. The expectations of economic growth and the expectations of inflation. Now, it turns out that there's a third thing that I don't go into great detail about, but it is actually important in the elective courses in global financial management, asset allocation. And this has to do with the correlation between expected future economic growth and inflation. So there's what's expected in terms of the economic growth. There's what's expected in terms of inflation. And there's also an expected correlation between economic growth and inflation. And we'll see when we do portfolio analysis that this correlation is very important. And this correlation could potentially, if it's negative, cancel out the two effects, or at least diminish them. So there's three fundamental building blocks that go into interest rates. The expected economic growth, the expected inflation, and the correlation between growth and inflation. And this pretty well defines the interest rate. Now, there's one other very important thing that I haven't mentioned that also is a determinant of interest rates. And that has to do with the investor herself. Now, I told you that there might be a motive for certain investors trying to hedge their standard of living. So they'd be able to give up some of their wealth today to ensure that next year they're protected, let's say, from this expected recession. So they wouldn't have to go and reduce their standard of living dramatically.